And 72% of the time the market goes up. And the answer came to me. And that's when I developed my chart. The answer came to me is because, just like Caterpillar, when they pull their money out, you get out. Whoa.
It's your daily dose of how to manage your money. And now it's time for Phil's Gang on the Off the Wall Street Network.
Oh, God. Are you nuts?
With your host, Phil Grande.
Bye. And welcome to my podcast. Okay, so a lot's going on today. And one of the biggest problems we're having today is that chips are really getting hit hard because the cost of chips are going up. That is scaring Main Street. That's a real problem. And liquidity is tightening. That's another thing that's going on. And so we're going to talk a little bit about that, and I'll explain, what's going on. So the first thing that's going on is that we have a problem with the chips because they're getting so costly because the lake is being drained. You say, what the hell are you talking about? Lakes being drained. I want you to think about this. The whole stock market survives on a lake of money of $50 trillion. When that lake starts draining, chips, tech get hit first. And that's what's been going on. So, and nobody's been talking about this. So again, think of liquidity as tightening. Think of the liquidity as a big lake with $50 trillion in it. The money belongs to the largest pension funds, the teachers union, the firefighters, police, corporate, sovereign wealth funds, GM, all the pensions, huge, 50 trillion. Now that's managed, of course, by 12 different institutions that we got to get back into the market. They're sitting on the sideline with there's 50 trillion in a lake. They always have 12 trillion in the stock market, 10 to 12 trillion, but they pulled the 10 to 12 trillion out. They only left about 1 to 2 trillion in there. We got to get them back, but that's another story. And that's why we got this volatility going on, because we got machines taking their place. But these 6 large institutions, T. Rowe Price, Vanguard, all of them, they manage the 50 trillion. Now, that lake, the 50 trillion, think about that, is the lifeline of the stock market. That money, that liquidity, that lake. And when the lake is full of money, markets do well. They float. When the lake starts draining, the markets sink. And money starts getting drained from the lake when there's too much debt. Everybody has to put the bucket in the lake, and they keep putting buckets in and bucket and taking water out. Now all of a sudden the lake starts going down. So when you get to a situation like we have now, where we have just too much debt, what did we say the other day? It was margin debt. It was what, 1.4 trillion. We never had 1.4 trillion of margin debt. I think in 2000, the dot-com crash right before that was like 280 billion. Then we had the housing financial crash. That was about 350 billion, 380 billion. 1.4 trillion, are you kidding me? So that money comes from the lake. So that money belongs to the firefighters and the police and the unions, and BlackRock and Vanguard manage that money and pull that money out of the lake. And that's how they get how they do these, how they leverage these lines of credit. So when money gets drained from the lake, and when there's too much debt, when you have too much refinancing. So everybody's dipping their buckets in. And the biggest bucket that's pulling the most water out is our Treasury, because Congress is spending $5 billion more a day than the tax revenue. What are you, nuts? So they issue each quarter new debt of $500 billion. So they have to go to the lake with the big bucket, pull more money out. So, and also remember, when yields keep going up, that's why pay attention to yields. These earnings are stupid. Earnings, no pro pays attention to earnings. It's in the rearview mirror. It's old news going back. You want to look at going forward. The market's forward looking, so use a tool that's forward looking, and it's the yields that are forward looking. That's what you follow, but that's for another day too. So high yields, high rates, that's like evaporation from the lake. So more water goes out of the lake. And this is what hurts the stock market, and you finally end up with a huge correction or crash. When you have less water left for stocks, yields, okay, are directly tied to that 50 trillion lake. And that's pretty dangerous. And yields, think of the yields are the drain plug, okay? The yields are the drain plug of that 50 trillion lake. And when yields go up, borrowing costs rise. And that's what's going on right now with the chips, and why you're seeing your chip stock starting to tank. Because of the borrowing costs, it's going up, and they keep spending all this AI, and they have to keep borrowing money. And where's that money come from? Well, the money comes from, again, the BlackRock and the Vanguards and the State Street go take the money that's in the lake, the 50 trillion from the firefighters, and they take that money and they provide it. And then the lake keeps on draining. So when yields rise, borrowing costs rise, liquidity drains, the lake level drops, and tech sinks, and semis sink faster. And then, of course, banks really get shaky. So the bottom line is liquidity is $50 trillion in that lake. That keeps our market afloat. And right now, that lake is draining. Too much debt, needs too much refinancing. The U.S. government is sucking up too much cash. They keep running to the lake. They keep issuing debt, treasuries. Because Congress, as I spoke about yesterday, Congress won't cut. They won't cut their spending programs. I mean, the dumbest programs, I went over 2 or 3 of them yesterday. They were so dumb, unbelievable. But they won't cut. They don't like to cut. Now, it used to be the big banks, the 5, 6 biggest banks would buy these bonds, absorb our debt. No more. Foreigners, they used to be big buyers of our debt. No more. So that's a real problem. It's going to be a real problem for the market. So when the lake drops, markets start getting weak, and that's what's starting to happen. Tech dies first. So think about what's really going on in this market. What Wall Street won't tell you is this lake of money that provides these stock markets with money. And whose money is that? The fire, the teachers, the 401ks, and the Vanguards and the rest of them, and T. Rowe Price, they manage that money. And they keep on providing money as it's needed, and they go there with their big buckets and pull that money out. So tech dies first, and when that lake starts draining. And tech needs cheap money to survive, especially with the AI, the cloud, the semis, software. They live on borrowing. People don't understand that. And when the liquidity starts tightening, that lake starts draining, money gets expensive. That's why you're seeing techs collapsing today. Because they need that money from that lake. And as that lake starts draining down, it gets more expensive. So what happens when tech They're going to build a data center and they need money. Well, they go, the first thing, where do they go? They go to BlackRock, they go to Vanguard, they go to State Street, because they have the access to the lake, that lake of money. So how long can we just keep on pulling money from this lake? Well, we're finding out you can't, because the money's getting low, the lake's getting lower, costs are going up, and we found out Czech is in trouble because of the borrowing. It's too costly, and that's why your chips are going down. Chip stocks are tanking because of costs of making these chips is going through the roof. But at the same time, demand's slowing. So now let's talk about the banks. Yields on banks are tightening. Now they're tightening today. Now that's the same as flattening. Okay, people use tightening or flattening. Now it occurs when the 2-year rises faster than the 10-year yield. So the spread starts to shrink and we move further and further away from our target of plus 150. We got to be at that 150. We're so far away from that 150, it's terrible, because what happens? The further you get away from that 150, you can't get the institutions to come back into the stock market where they're 10 to 12 trillion. Now, they got a lot of money that's still invested in the 4 biggest chip machine makers, Clack and so forth. But right now, what's happening is that they're just sitting on the sideline because these yields are getting crazy. And remember, the yields affect the lake. The higher the yields, the lower the lake. But nobody wants to talk about this. Nobody even understands how the market works. Nobody understands that lake of 50 trillion that is all your savings, your 401k money, okay, your mutual funds. That's all being managed by Vanguard and State Street and so forth. And every time the tech industry needs money, they just call one of their buddies over there and they send more money in. But now what's happening is it's now gotten to a point that it's starting to hit the tech stocks. So we've been shorting the tech stocks. Now there's the 4 machine tech stocks, we call them. They make the machines for the chips. They're fighting. They're financially engineering those specific stocks, those 4 stocks, which are the most powerful stocks out of 700. Out of 700 stocks that trade every day, the most popular, there's 12 stocks that are holding up the whole market. 4 of the 12 are holding up probably 65% of the market, and that's the 4 machine makers. And they're doing everything to make sure they don't drop below the 50-day moving average. And you can see it. One of them did drop. And as we're doing right now, we're shorting that one that did drop. And we'll continue to short the ones that drop below the 50. But they're going to keep dropping below the 50. And then when those 4 panic selling comes in, that's a problem. But not if you know how to short. You can make a ton of money. You make more money shorting than you ever make going long. So the bottom line is we have the lake. It's starting to drain down after all these years. As wonderful as tech is, they're expensive. They need a lot of money. And now it's gotten to a point that these managers of the 50 trillion, whether it's Vanguard or BlackRock, they want more money. They want higher yields. So that's becoming a real problem. And again, while you're in earnings season, stop watching the earnings. They do nothing for you. Earnings are looking backwards. Last quarter, do you really care about last quarter? I want to know where that money from this lake is going to go next. And you can follow that money. You always know where that money's going next if you follow the institutional money. If you can follow their footprint. But nothing good comes out of these. It's like earnings season's like they're watching a Super Bowl. Everybody gets so excited with earnings season. it's like reading a 5-month-old New York Times or Wall Street Journal. Follow the yields, follow IWM, and follow the yields. You always know where that money is going before the market does. And that's what you need to know. Where's that money going from that lake? Where is Vanguard and the rest of where are they loaning that money? Where's it going? And you always be in the right stocks. Okay, well, thank you for joining us today again here at Phil's Gang. Hope you enjoyed this, and we'll see you tomorrow at the same time, the same place, philsgang.com. See you on the charts.